Hello, my name is Yana, and today I want to talk about basics of sales of partnership interest. Prepare for business tax accounting, chapter 10, learning objective 1. Let's start. Learning objectives. What is partnership? Taxes and partnership, sellers, issues, outside basis, inside basis, what is hot assets, buyers and partnership issues. First, let's talk about what is partnership. Let's remember. Hello, my name is Yana, and today I want to talk about the basics of sales of partnership interests. Prepare for business tax accounting, chapter 10, learning objective 1. Learning objectives. What is partnership? Taxes and partnership, sellers issues, outside basis, inside basis, what is hot assets, buyers and partnership issues. First, let's remember what is partnership. A partnership is a formal arrangement by two or more parties to manage and operate a business and share its profit. Exist two types of partnership: general partnership and limited liability partnership. Taxes and partnerships. There is no federal statute defining partnerships, but nevertheless, the Internal Revenue Code includes detailed rules on their federal tax treatment. Partnerships don't pay income taxes. The tax responsibility passes through to the partners, who are not considered employees for tax purposes. Individuals in partnership may receive more favorable tax treatment than if they founded a corporation. That is, corporate profits are taxed as the dividend paid to owners or partnership. Partnerships' profits, on the other hand, are not double taxed in this way. First, let's talk about sellers' issues when the partner sells his interest in partnership. Many partnership arrangements don't allow the unrestricted sale to the public, and the remaining partners don't want to be forced to accept anyone who may not be desirable for the business, who may not have the requisite skills or may have not get along with the other partners. However, where the sale of the partnership interest is allowable, the interest can be sold in the whole, on the part, at a profit or a loss. Because tax law views a partnership both as an entity as an aggregate of the partners, the sale of a partnership interest may result either in a capital gain or loss, or a portion of the gain may be taxed as ordinary income or loss. This differs from the sale of corporate stock, which is viewed as a separate entity from the shareholders, in which the sale results only in a capital gain or loss. Here is the formula where we can how we can calculate capital gain or loss. The amount of the sale, we have to subtract partnership interest, and it represents the partner's outside basis. Next, let's define what are inside basis and outside basis. Inside basis, this is the partnership tax basis and the individual assets. The outside basis represent each partner's basis in the partnership interest when a partner contributes property to the partnership. The partnership basis in the contributed property is equal to its fair market value. The outside basis of the partner increases only by the amount of the basis that the partner had in their property. Now let's look at the example. You contribute a land to a partnership with a tax basis of $10,000 and fair market value of $50,000. Your other partner contributes $50,000 cash. Since the fair market value of the land is also $50,000, you each have equal equity in the partnership, and the total inside basis of the partnership is equal to the $100,000, your contributed contributions. However, your outside basis differ from your partners, since your outside basis is $10,000, while that of your partners is $50,000. If you sold your partnership interest for $50,000, you would recognize a gain of $40,000, whereas your partner, if she sold at the same price, would recognize no gain. Now let's look at the next example that will show us how to calculate recognized gain when the partners sell their partnership interest. Last year, the ABC company sold its interest to CCS on June 30 to Mark Randall. Mark Randall anticipated that this CCS would be profitable and pay to the ABC company $100,000 for its interest in the company. ABC company's share of CCS liability as of June 30 was $24,000. ABC company basis in its interest at the sale date was $105,000, including its share of CCS liabilities. What amount of gain or loss did ABC recognize on the sale? So we can see that first we have to calculate amount realized, and that will be equal cash received plus debt relieved. Then we have to subtract from the amount realized basis in CCC interest, and it will be equals $19,000. Next, let's talk about hot assets. What are hot assets? Hot assets are business assets that have the potential of built-in ordinary income. In other words, these are assets that would generate ordinary income if sold. The main two examples are inventory and accounts receivable. A partnership that has unrealized receivables and inventory means hot assets that, when sold by the partnership, causes it to recognize ordinary income, complicates the taxation of the selling partner's interest, since some of the gain or loss may be ordinary rather than capital. The selling partner must recognize the income just as if those assets were sold, with the ordinary income being allocated to the partner. This will prevent the conversion of ordinary income into capital income that is usually taxed at a lower rate through the sale of partnership interest. Now let's look at the balance sheet. Here we see that hot assets are accounts receivable and equal $15,000 and $6,000 depreciation, that will be equal by $86,000 minus $80,000. Account receivable are unrealized receivable because the company has not included it in income for tax purposes under cash method. Depreciation is also considered as unrealized receivable, and inventory would be considered as a hot assets as well. When partners sell his interest that holds hot assets, modifies his calculation of the gain or loss to ensure that relate to hot assets is properly characterized as ordinary. The process of determining the gain or loss as follows. First step, calculate the total gain or loss recognized by subtracting outside basis from the amount realized. Second, calculate the partner's share of gain or loss from the hot asset as in the partnership sold their assets in their fair market value. This represents the ordinary portion of the gain or loss. And the final step is subtract the ordinary portion of the gain or loss in the step 1 from the total gain or loss from the step 2. This remaining is capital gain or loss from the sale. And now let's look at the example. Here we can see that account receivable fair market value should be subtracted from their basis, and it will give us capital gain $10,000. Then we have to multiply by the 30% their partner's share, percent of share. Then equipment will be equal $6,000, and multiply by 30% of interest share, and it will give us ordinary income of $4,800. Then to define the capital gain, we have to subtract total gain $90,000 from ordinary income. Will give us capital gain $30,300. Now let's talk about buyers and partnership issues. A new investor in a partnership is of course concerned with determining how much to pay for the partnership interest. However, his primary tax concern about his basis and his share of the inside basis of the partnership assets. In general, for a sale transaction, the new investor's outside basis will be equal to his cost of the partnership interest to extent that the investor sharing the partnership liability, his share of the partnership increased his outside basis. Now let's look at the example. When Mark Rental accrued ABC Company's 30% interest in CCS Company for $100,000 on June 30, he granted his share of CCS debt just as the ABC had done. As a result, Mark will be allocated his share of CCS allocable debt in accordance with his 30% profit-sharing ratio. What is the outside basis of Mark's accrued interest? Here we see the initial basis equals $100,000 cash paid to the ABC Company. Share of CCS liabilities will be equal $24,000. And the outside basis will be equal $124,000. 100 plus $24,000. Then the Mark share will be equal $99,000. This would be calculated by total capital amount, which we can see in the balance sheet. His amount tax basis equals $75,000 plus liability $24,000. So Mark's share will be equal $99,000. A sale of partnership interest often results in a difference between a new interest inside and outside basis, because the outside basis and the price based on the fair market value on the inside basis is the seller's share of tax basis in the partnership asset. The partnership experienced very few tax consequences when a partner sells his interests. The sale doesn't affect the partnership inside basis on its assets. The new investor's share of inside basis is equal to the selling partner's share on inside basis at the sale date. And in the sale of partnership interest, the selling partner's interest, the selling partner's tax capital account carries over to the new investor. Here is the conclusion. Today we talked about the partnership, what is partnership, seller's issues, what is inside basis, what is outside basis, what are hot assets, buyer's issues. Here are the sources that I used to prepare this presentation, and thank you for the attention.